Hello, my name is George, and in this video, we're going to break down exactly how to consolidate debt with bad credit. We'll go over how it works, how to find lenders, the risks involved, and some other options if debt consolidation doesn't seem like the right fit. If you've got debt piling up and your credit score isn't looking great, you might be wondering, can I even consolidate my debt? Now, the good news is that yes, you can. The bad news, it's not always easy and it's not always the best choice. But that's what we're here to figure out today. Let's get started. By the way, all the companies that I'm going to mention in this video are available by clicking the first link down in the description of this video. Some links in the description are affiliate links. Thank you so much for supporting my channel, and now let's get started. What is debt consolidation and how does it work? Debt consolidation is when you take out one new loan to pay off all your other debts. Instead of making multiple payments every month, maybe to credit cards, personal loans, or medical bills, you roll everything into one. The goal is to get a lower interest rate, a more manageable payment, or both. Now, if you have good credit, this can be pretty straightforward. But if your credit is bad, lenders see you as risky, and getting a loan with good terms can be tough. That doesn't mean that it's impossible though. It just means you need to be smart about how you go about it. What are the steps to getting a debt consolidation loan with bad credit? If you're hoping to consolidate debt but your credit score isn't great, the first thing you need to do is figure out where you stand. Credit scores range from 300 to 850, and if yours is below 580, lenders consider that poor. You can check your score for free through Experian, Equifax, and TransUnion, which are the three major credit bureaus. Once you know your score, take a few minutes to look at your credit report. Sometimes there are mistakes. Maybe an old debt that should have been removed or a late payment that wasn't actually late. Fixing errors can give your score a quick boost. Now, if your credit isn't in great shape, you'll need to find lenders who are willing to work with you. Not every lender accepts bad credit borrowers, so you'll need to do some research. Online lenders are usually the best bet because they have more flexible requirements than banks or credit unions. Some of them even let you check if you pre-qualify before applying, which is helpful because it won't hurt your credit score. Another way to improve your chances is by getting a cosigner. This is someone with good credit who applies for the loan with you, making the lender feel more comfortable approving you. Just keep in mind that if you miss payments, your cosigner is on the hook for the debt. If you don't have a cosigner, you might consider a secured loan. This means putting up something valuable, like your car or savings account, as collateral. It can make it easier to get approved and even lower your interest rate. But be careful because if you can't make your payments, the lender can take whatever you used as collateral. So once you get approved, here's what happens next. Once you find a lender and get approved, they'll either send you the money so you can pay off your debts yourself, or they'll pay off your creditors directly. Either way, from that point on, you'll only have one loan to worry about. Before you sign anything though, read the fine print. Make sure you understand the interest rate, the monthly payments, and whether there are any fees. Some lenders charge fees just for giving you the loan. Also, check if there's a prepayment penalty, which means they charge you extra if you pay the loan off early. Where can you find debt consolidation loans when your credit score is low? If you're looking for a lender, you've got a few options. Online lenders are usually the easiest to work with if you have bad credit. They don't have the same strict rules as banks, and some even specialize in working with people who have lower credit scores. The downside is that their interest rates can be high, so you need to compare offers carefully. Credit unions and small banks might be a good choice if you already have an account with them. They sometimes offer better terms, especially if you've been a long-time customer. If you own a house, you could look into a home equity loan or a home equity line of credit. This lets you borrow money using your home's value. The interest rates can be lower, but if you can't pay, you risk losing your home. What are the pros and cons of debt consolidation? Debt consolidation sounds like a great solution, but it's not perfect. On the plus side, it simplifies your payments. One monthly bill instead of 5 or 6. If you get a lower interest rate, you could save money. And depending on your loan terms, you might be able to pay off your debt faster. But there are downsides too. If your credit is bad, you might not get a better interest rate than what you're already paying. Sometimes, consolidating debt can actually make your monthly payments higher, depending on how the new loan is set up. And most importantly, consolidating debt doesn't fix the problem that got you into debt in the first place. When does debt consolidation actually make sense? A debt consolidation loan makes sense if you can get a lower interest rate than what you're paying now. And if you're serious about not adding more debt. If you have multiple high interest rates debts and struggle to keep track of them, rolling them into one loan with a fixed monthly payment could help you stay on top of things. But if you're already struggling to make payments or have a habit of overspending, consolidation might not be the best move. You could end up in an even worse financial situation if you take out a loan and then keep racking up debt. What if debt consolidation isn't right for you? What are other options? If consolidation doesn't seem like the right fit, there are other ways to tackle debt. One option is to take a closer look at your budget. Sometimes making a few cuts in spending can free up enough money to start making bigger debt payments. Another strategy is called the debt avalanche method, where you focus on paying off the debt with the highest interest rate first while making minimum payments on everything else. This saves you the most money in the long run. There's also the debt snowball method, where you pay off your smallest debt first, then move to the next one. This doesn't save as much in interest, but it can keep you motivated because you see progress quickly. If you're really struggling, credit counseling could be a good option. A nonprofit credit counselor can help you come up with a plan and might even be able to negotiate lower interest rates with your creditors. Final thoughts. Should you consolidate your debt or look elsewhere? At the end of the day, debt consolidation isn't a one-size-fits-all fix. It can be a smart move if you qualify for a better interest rate and can commit to making payments. But if your credit is really bad and you're not careful, you could end up with an even higher monthly payments and more debt than before. Remember, if you're looking for the best debt consolidation companies, the link is down in the description of this video. I hope this video was helpful. Thank you so much for watching. Till next time.